One of the key macro metrics which everybody seems quite worried about is the very, very tepid credit growth that we are seeing in the system month after month after month. Yet, it's not showing up yet in the reported numbers of at least the top corporate banks or the retail-facing corporate banks. Do you see sluggishness getting into the banking system? Because that will be a blow which will be difficult for the market to digest.
Yeah, there are several questions there. I mean, the first bit is on credit growth. The credit growth will remain tepid. There is a step change happening in the banking system. And the change is basically that the wholesale banking system is obviously moving away. It's got disintermediated by the corporate bonds. And the corporate bonds are clearly now more active, which is through the sovereign funds or the insurance money that is available. So that is clearly taking over. So you will possibly see, or we will possibly see, a more sluggish credit environment that we have. The second bit is to notice that the wholesale banks are basically now moving away as the cost of lending to these projects through corporates is becoming, or the margins, spreads and margins of lending to these corporates is clearly thinning down. So the wholesale banks have moved away from corporate lending or project lending towards more SME and retail. So the fact that to sustain their margins at current levels, they will need to move away from the corporate lending where the margins and spreads are thinner. So effectively, I think that if they continue to be in the same space of wholesale lending, there will be a sharp decline in NIMs, which is a reason to think and worry about. The other bit is moving to retail and SME space, which is reasonably a turf where you've seen the NBFCs and the small private retail banks kind of running very hard, and they are incumbents in that space. If you want to go to that space, basically you will see more competition creeping in because the wholesale banks will go into that space and push the margins down because there will be more competition which will creep in there. Effectively, the third bit is obviously technology and the delivery system, which we see the new banks coming up with. They are far more quicker, they're far more rapid, they obviously work with lower cost, and hence the spreads will kind of come under pressure. The whole banking system, I suspect, in India is going through this phase of change, and that will result, and we need to think about lower spreads and lower NIMs going forward. And there is a potential. I mean, the other question which you spoke about is the lower credit growth. I think a fair bit is getting replaced by the domestic flows into insurance and mutual funds. So you should not think about credit growth as 3 to 5%, which is only the banking system. You should think about credit growth, which includes the money which is being lent in the non-corporate, the corporate bond side, which is the NCD market, which has become very active. And that's a function that we need to kind of put together and say that the overall credit growth is about 9 to 10%. So if the non-banking system is going to take over the wholesale lending and other pieces, I think there is a very serious risk of NIM settling much lower.
How do you play this space then, Krishna, as an investor? I mean, which part of it do you position yourself in, given the kind of fairly significant changes you're pointing towards?
So it is a fair bit of challenge. So we are very valuation driven people, right? I mean, we think about, so the private sector expensive banks are obviously out of the purview. What we think about is the banks which are less vulnerable, which have a reasonably broad-based book and are much cheaper in valuation, where there is a fair bit of concern in terms of high NPL accretion, belief that they will not be nimble enough to move their banking system to adapt to the changes that are happening. So we have a sprinkle of private sector banks which are much cheaper compared to the peers, and also a few public sector undertakings which are larger, and hence we kind of create a basket. We are also in the NBFC space, which are basically, some of them have got bruised in the last few quarters, and we think that there was an opportunity. We thought there was an opportunity to kind of buy into them. And we kind of have a basket of both private, public, and NBFCs. We kind of we are reasonably brave. We were reasonably brave to kind of have bought some of the names that people were extremely concerned about when the system actually went through a reset. We bought names which were about 0.6, 0.7 book, but reasonably sustainable ROEs of close to around 17, 18%.
The other space which would be challenging you as an investor now is IT, and Infosys numbers would not have made it easier for you. But I mean, I know you own some of these larger IT companies in your portfolio. How do you see the road forward? I mean, should you just keep holding them, hoping for a turn, or do you think they're probably going to be fairly low growth companies for a significant length of time?
So that space has been quite a worrying space, for a variety of reasons. First is obviously the changes which are happening in the world. There are huge disruption in terms of technology evolution which is happening now. And I think there is a fair bit of AI, robotics, which is kind of changing the overall landscape. The second bit which is changing is the evolution to cloud and increasingly adoption of cloud, which is happening. So these are changes which are going to be very, very scary as far as our Indian IT space is concerned. Are they going into X growth? I think not yet. They are not yet X growth. They are not yet to be written off. They are capable of adapting. They will go and acquire some businesses. They will manage change, and it is going to be a bit of a challenge. And I think the way we have interacted with these large IT companies, they are mindful. They are not blind to these changes. The fact that these changes are happening, they will go, because they're very cash rich. Some of it they will return, some of it they will use to acquire. They will continue to generate cash. If you have about close to 30 to 40% of your total market cap in cash, you will happily play them along, and their ability to generate cash is also going to be a kind of a floor where they will kind of distribute back. So there are multiple things. First is the business challenge, second is the evolution, and third is the ability to kind of keep generating cash and returning. But having said that, it worries that these stocks are, trading at about 15, 16, which is one standard deviation cheaper than what they have been historically. It is obviously value, right? I mean, at some stage you must believe that these people have done whatever they've done to get a 10 billion mark, and they will evolve. And it is not a hope trade, it's not a faith trade. It's a kind of a trade where we believe that this process of transformation in the world, which is happening now, the Indian companies will not get left out. What is not working for them are two things, or three things maybe. First is obviously the currency is not working for them. And second is the protectionism, which is pretty global. And third is their inability to kind of automate their system, or abuse the word automate in their system, which is kind of making them look a little archaic. So they have to kind of work around these three situations to kind of come out of the hole.
I want to ask you about Telecom, because wanted your thoughts on whether, as an investor, you've included some of these names, because I'm sure would have been out of favor for the last many years. But after the recent changes, not just of the entrant of a new aggressive player, but also the consolidation which is going on, are you taking a relook at the sector, or do you still remain quite somber about its prospects?
So that is one space that really worries me. That's just really a big change happening in the overall market. The total revenue base is approximately around 200,000 crores, and that's what the sector does today. Close to around 90% is voice and 10% is data. Here comes a challenger who says that voice is free, and I will charge you only for data, and let's grow from here. And let's grow data harder and harder. And he's going to make that step change, or he's going to be the biggest disruptor of the entire sector. All these telecom companies have paid, their arm and leg to get or acquire spectrum, and they've incurred cost, and they've done whatever they have. Once the voice becomes free, increasingly, this 200,000 crores, which you will see shrinking rapidly as voice becomes free. And the classic example that somebody told me was he was on a 2599 plan with Vodafone, and in 6 months' time, Vodafone is offering the same service at 699. It must be across all operators. It's not just picking on Vodafone. But the fact is that if the loss of revenue in terms of voice is going to cause this industry to shrink rapidly before data catches up, the disruption is going to be for much, much longer, and balance sheets will possibly get seriously destroyed as we emerge out of this with more sanity and more sensible players in terms of finances. So I'm actually very concerned about telecom as a space and more concerned about the collateral damage that will happen. The collateral damage is the ecosystem that the telecom sector works on, the ecosystem that supports the telecom sector, because if there is a revenue shrink and EBITDA loss, or EBITDA loss, I mean there is going to be a reduction in EBITDA margins, I'm not sure whether they're going to go out and spend as much money as they have in the past. And also the small and medium enterprises that have been associated with them, they will see a sharp change in the way they work. So I really worry as to how much uglier it gets before it gets better.
Okay, let me ask you about a more generic question, because I met a lot of your peers who are emerging market investors of late, and some of them said maybe we are at the start of a 4-year emerging market cycle again, because it went out of fashion. For 4 years we had a real difficult time convincing investors globally to invest in emerging markets as an asset class. But maybe what we have started to see this year is again a new cycle in emerging markets. People are skeptical right now, they may be in denial, but this is how a cycle typically starts. Are you convinced, because you've been investing in these markets for many years now, that we've embarked on a new earnings and a stock market cycle in emerging markets?
You know, there are a couple of markets which got completely left out in the last couple of years. The classic one is Philippines, Indonesia, and Taiwan. They got completely left out of the rally, and they were all trading ex-growth, and you know, Philippines obviously suffered because of valuation and change in government, but reasons follow, right? I think you know, the way I'm looking at is there are pockets of Asia which is actually very, very cheap. There are pockets in Asia where people are paying enormous price for growth. There are pockets in emerging markets which actually for us includes LATAM, the Eastern Bloc in Europe, and multiple other markets where there are a lot of things which are very cheap. So when these markets start to rally, you will call it an emerging market rally, but it doesn't mean that people who are paying high price for growth will actually kind of benefit out of it when they don't see growth. I wouldn't be surprised, because the emerging markets are obviously quite cheap. The emerging markets are very politically vulnerable. The emerging markets are capable of growth, but in a softer interest rate environment, it really helps them to grow faster, which I don't think is the case. The other bit is in terms of political stability. I think emerging markets are seeing more politically stable countries, which could also drive. So there are multiple factors which will drive. But the other bit is I think the money flow has to be to more you know, thematic stroke, sustainable 5-6 years of earnings growth, which could be in emerging markets, and pockets of emerging markets obviously very, very cheap.
Krishna, on that note, I'll thank you. It's a pleasure talking to you as always. Thank you very much for your time today.
Thank you very much.